Investors and private equity investors in particular find themselves in an interesting position at the moment. They typically would invest private capital into a company with a view to that company listing at some stage in the future and then taking the returns upon the listing. As things currently stand, the IPO market in Asia generally is far less buoyant than it has been in the past. It's not offering the same opportunity for private companies to list, and that is giving rise to a situation where the PE funds who have injected capital into these private companies are starting to take a more intensive look at their portfolios. They're starting to try and understand better what their alternative exits are. So if the IPO isn't there, how else are they going to exit the position, or are they happy continuing to work alongside the incumbent management? It's also meaning that they're focusing a lot on how the incumbent management is actually operating the company. And that in turn gives rise to a more in-depth analysis of what their rights are under their investment agreements and their rights under the Articles of Association. In circumstances where they're unhappy with the way in which the companies are operating, starting to assess what their rights and remedies are, both to exit that investment in a quick and efficient manner, but alternatively to take steps against the management, either to get hold of information that they're not getting, or to take steps to remove the management, or just change the way in which the company is being operated. And this in particular has been an area where we've seen a real uptick in interest and work over the last year or so. It's been sort of widely publicised that there is an increased concern over the way in which PRC companies in particular are adhering to corporate governance requirements, and you will have seen in the last 6 months the Muddy Waters articles in relation to Sino-Forest, and that's just the tip of the iceberg in terms of the number of companies that have listed, particularly in the US, which are now facing increased concerns from investor base that is not sure as to whether or not the incumbent management are complying with their obligations. One of the things that we have seen, as well as just a general uptick in work, is an increase in the jurisprudence in the BVI and Cayman in relation to how investor rights are actually determined by the courts. And we've seen a divergence in approach being taken by the BVI and the Cayman courts, such that an investor that looks to redeem in Cayman will typically, depending upon the wording within the underlying contracts, but will typically have a different position to an investor that looks to redeem out of a BVI investment company. So whereas one will have the ability to be a creditor with all the rights that a creditor has against the company upon properly redeeming their investment, the other will not be treated as a full creditor for that purpose, will not have the ability to take steps against the company to wind it up, won't be treated as a creditor in the liquidation, and will generally rank behind the unsecured creditors in any proof of debt process within a liquidation. So very, very different analysis being taken or being adopted by courts in the BVI as compared with courts in the Cayman. And I think that's important for a number of reasons. Firstly, for investors who are already invested in Cayman and BVI entities, trying to determine how they're going to affect an exit, what their leverage position is. And very often this is a leverage point, because often investor isn't looking to put this company into liquidation. They're not looking for the nuclear option against the company, but actually they're looking to increase the leverage that they have to try and effect a settlement and then a negotiated exit from their position. But the leverage that they have does depend upon the rights that they're given. And so it is important for those investors with existing investments to understand how those rights and remedies are going to play out in a contentious scenario. But secondly, from a a perspective of an investor who's about to enter into investments in Asia via offshore companies, and is looking not just now at which structure is going to be the most cost-effective and tax-efficient means of investing their capital into that company, but also looking at the other end and asking questions about, well, what remedies is this going to give me in the event that this investment doesn't turn out in the way in which I want it to? How quickly can I enforce my rights? What steps can the incumbent management and the debtor entity in particular take to prevent me from enforcing my rights? How am I going to fare against other creditors who also have interests in the company? And so these are the right questions to be asking. And what we're seeing more and more is that amongst the private equity clients that we work with, is that they're asking these questions right at the outset. They're much more cognizant of the issues that might materialise in the future, whereas previously in the sort of the full-on bull market, everybody's assumption was, well, this will be a 12 to 18 month play and then we'll exit via an IPO. And so I think it's a healthy situation for them to be in at the moment when they're assessing all their rights right at the outset. And it's certainly the approach that we're recommending be taken.